What feels like a market crash is actually shaping up to be another massive opportunity. If you missed the April 2025 sell-off or the last 2 years of the most hated bull run, then this is the part you really don't want to miss. Even with beaten down futures turning green this morning, another window of opportunity might be right in front of us. So in this video, we're going to break down what's actually happening under the hood right now and why this sell-off looks the way it does. Then I'm going to get into explain some specific stocks that I feel have some major opportunity for buying into this environment. Now remember, we're not trying to call the bottom on stocks here, and we're not chasing hype. We're just focusing on risk-reward setups that don't show up very often. The best buying windows almost never show up when confidence is high. They show up when everything feels wrong, like yesterday. Your screen is red and your gut is telling you either panic, sell, or just sit on your hands. And right now, that's exactly what it feels like. Tech and software look like they're crashing, but what we're actually seeing isn't a market collapse. It's money moving quietly and deliberately out of one pocket of the market and into another one. Now, before we dive in, if you get any value from this, please hit the subscribe button or the like button. And a quick disclaimer, I am not a financial advisor. This is not financial advice. Now, I know exactly what it feels like when you open up your account day after day and everything is red. Logic goes out the window and your brain starts asking the wrong questions. Things like, should I sell? Did I miss something? Or is this time different? And honestly, that's when the biggest mistakes happen. And after more than 15 years in the market, I can tell you, those questions rarely lead to good decisions. So, with that being said, let's zoom out for a second and look at what's actually happening across the markets. When entire groups of stocks move together, especially software and high growth tech, it starts to feel like something is seriously wrong. From high growth names like Snowflake and ServiceNow, to deeply embedded systems like Salesforce, Intuit, and Microsoft, software stocks across the board have been hit at the same time. So, if you're heavily concentrated, it doesn't feel like a pullback. It actually feels like a complete market crash. Everyone is saying software is crashing because AI is replacing SaaS or agents are killing software. While that's partially true, there's more to the story. Software stocks aren't crashing because AI exists. They're actually crashing because the economics of software just changed and Wall Street finally noticed. I've built a large online business over the last decade, so I've lived inside software, tools, and AI. There's a missing puzzle piece most people are overlooking. While everyone is focused on these AI agents that will take over the workforce, I feel there's something more disruptive. There's a bigger shift, and it's tools like Claude Code. Claude Code isn't an agent, it's not a chatbot. It's basically a senior engineer in your development environment able to reason across projects. Now, when I say I use Claude Code, I don't mean I'm asking it for snippets. I mean I'm building tools, structuring databases, writing back-end logic, building front ends, and creating full apps I used to pay for. And the wild part is I don't even know how to code, and I will never be a coder. Now, for the record, that doesn't kill software overnight, but it completely changes who has pricing power. When it suddenly becomes easier to build things, a lot of software loses its grip. Prices come down, moats shrink, and the real value starts moving away from flashy dashboards and into infrastructure underneath everything. And once you step back and look at what all the major players are spending combined, like the 150 to 200 billion CapEx numbers, everything is starting to make sense. That's not hype, that's infrastructure spending at scale. It's already clear that companies are ditching software that once felt necessary. Now think about tools like Monday.com, Smartsheet, Duolingo, SoundHound, and similar feature-level software. These sell convenience, not deeply embedded systems. For me, they don't fit my risk framework right now. Now, there's a line forming in software, and it's not AI versus non-AI. It's deeply embedded systems versus weak programs that never truly earned their place. Now, I know I'm going to upset a lot of people, but many lightweight SaaS tools only existed because building alternatives used to be hard. They weren't embedded. They didn't own critical data. They weren't mission critical. Those are the ones getting hit the hardest, and a lot of features they offered can be built by a beginner using Claude Code and various API tools. Now, meanwhile, platforms like Salesforce, ServiceNow, Intuit, Microsoft, they sit deep inside how businesses actually operate. I'm not saying to load up the boat, but walking away from those systems isn't realistic for many companies. AI isn't wiping everything out. It's just exposing which software people truly depend on and which tools were never that important to begin with. And despite how powerful tools like Claude Code are, most companies don't want to build and manage full platforms themselves. But let's be real for a second. The real work starts after it's built. You have to maintain it, you have to secure it, you have to make sure it scales when usage spikes, you have to make sure it doesn't break at 2 a.m. when your business depends on it. And when something goes wrong, someone has to be accountable. So the truth is, most companies don't want to become software companies. They don't want to manage updates, patch vulnerabilities, deal with downtime, or babysit infrastructure. They just want the thing to work. And that's why deeply embedded platforms don't disappear overnight. Even as AI makes building easier, you still need reliable systems, high security, and accountability. And that's why many people are panicking, and businesses will always default to embedded platforms they already trust and let those platforms handle the AI layer. People who really understand this are not panicking. Now let's talk about what's really making this feel scary. The current market rotation. When money leaves software and AI, it doesn't disappear. Some of it rotates, some goes to cash, and some of it waits for maximum panic. That's why tech can look ugly while other sectors hold up or make new highs. For years, the playbook was simple. We buy big tech and we watch it go up. That worked really well for a lot of us. But things are shifting. Money is rotating into real economy sectors. Energy stocks like ExxonMobil and Chevron are holding up. In materials, copper producers and steel companies are holding firm. Industrials like Caterpillar and Deere are up strongly. Consumer staples like Costco, Procter & Gamble, and PepsiCo are steady, while tech swings. Now, none of this is exciting and none of it goes viral. This is what markets do when the easy money is gone and investors stop chasing stories and start caring about what actually holds up. Money isn't leaving the market. It's rotating towards companies with cash flow, pricing power, physical products, and exposure to infrastructure, energy, materials, and reshoring. To be clear, I'm not saying tech is dead. I'm still buying high conviction names on pullbacks, which I will cover in a moment. But if you're only watching software, it feels like a crash. We know that. Zoom out and let's just look at the rotation. Now, here's where I want to slow people down a bit. When tech comes back, you don't need to nail the exact winner. Chasing late is how people get burned, and trying to time the bottom usually ends badly. I'm already buying, but with context. My portfolio is built around 3 themes: high growth, asymmetric upside, and long-term capital preservation. Now that preservation bucket is my largest, not because I'm bearish, but because it keeps me invested and emotionally steady, and I sleep really good at night. Now, I think it's important to always have a bit of safe stuff like energy, materials, industrials, and consumer staples. Now, I'll cover this topic in future videos on what ETFs can work here for capital preservation, so subscribe if you want to be notified on that video. But let's talk about what I'm actually adding today. SoFi is already in my growth portfolio. I originally bought around $10. This stock has been crushed, but the business didn't disappear. Member growth, product expansion, and the ecosystem are still there. That disconnect is what I'm buying into. Watch my latest SoFi video for coverage on that one specifically, and I'll get into the other names. Now, I'm also buying Microsoft for the first time in my growth portfolio. It can easily sit in my capital preservation bucket, but I'm putting it in the growth. Now, this isn't some speculative tech bet. Microsoft sits at the center of how businesses actually operate. Windows, Office, Azure, enterprise security, cloud infrastructure, and now AI layered across all of it. They generate massive cash flow, they have real pricing power, and once a company is built on Microsoft's platform and ecosystem, ripping it out isn't realistic. When markets sell off and tech gets hit as a group, this kind of business is what I'm comfortable leaning into. And yes, Amazon too. Even after the earnings and what they reported on their CapEx, the market loves to overreact to Amazon. One headline, one margin number, one line about AWS growth, and people act like the business is suddenly broke. Well, it didn't. AWS is still one of the most important pieces of global cloud infrastructure. Advertising is quietly becoming a massive profit engine. Their logistics network is something almost no company on earth can replicate. And on top of that, they're pushing hard into automation and robotics to drive efficiency at scale. What I also find really interesting is that Amazon is supplying infrastructure and chips that power models like Claude. They're not just talking about AI, they're actually selling picks and shovels behind it. When Amazon sells off on earnings like I saw yesterday, I don't see this as a warning sign. I actually see this as a dominant platform getting temporarily mispriced. Lastly, let's talk about Salesforce. This is a long-term gainer here, in my opinion. It's on my watch list for a while, and I talked about it in a recent video, and now it's moving into my growth portfolio. This isn't a flashy AI trade. Salesforce deeply is embedded into how businesses actually manage customers. Sales pipelines, data, and operations is all managed through this platform. Once a company builds on Salesforce, ripping it out again is painful, expensive, and risky. The stock got hit along with all software, but the business didn't break. Cash flow is there, enterprise customers are there, and it's still one of the platforms that sits right in the middle of daily operations. At these levels, the risk reward finally makes sense for me. Now, I'm going to be honest. I have heard from people who actually work at Salesforce. They've mentioned customers are dropping, but upon further analysis and research, I feel the price is starting to make sense. I'm not going all in here, but I'm starting position and it makes sense to me. So let's wrap this up. Markets don't reward panic. They reward patience with a plan. You do not need to predict the next headline. You just need to understand where the money is already going. Now, if this video helped you see the market more clearly, please let me know what you're watching in the markets, and I'd love to hear your comments. And if you like this type of video, please don't forget to subscribe, and we'll see you in the next one. Thanks for watching.